Hello people, welcome to the class. This is Financial Economics and I am Sandeep Victor. Today we're going to be learning about the binomial model. In our introductory session we said that one of the things we'll be learning in this class is how to price the stock options. So this class is our first introduction to the pricing of options then. Okay. So we're going to be taking baby steps to option pricing. What we mean by that is that this is going to be a very simplistic model, meaning we'll be making lots of assumptions about how various financial markets and financial instruments themselves work. So for example, we'll be making some very simplistic assumptions as to how the stock prices behave between, let's say, time period t and t plus 1. And what are the kind of interest rates that are charged on borrowing and lending behave like? Looking at the simplicity of the model and the kind of assumptions that we are going to be making, you might think that this model is a bit unrealistic. While we will study more complex models that are closer to reality later on, why are we studying this simple model now then? The advantages of starting with simple models is that the mathematics and statistics that you have to deal with gets considerably easy. That we can get ourselves familiar with some very important financial concepts right away without getting bogged down with complex mathematics or statistics. So that we will be able to quickly appreciate such financial concepts and ideas like construction of replicating portfolios, which we will say is one of the central and beautiful ideas really to the pricing of options. And then we have the central concept of no arbitrage, which is an assumption that is close enough to reality for our purposes. Similarly, we'll be looking at such things as rebalancing the portfolios, what self-financing strategies are, and how to construct hedging portfolios. And as well, what are risk neutral probability measures and their very important role that they play in pricing the options. Okay, so don't worry about all these things now. We will be spending quite a bit of time on these things as we go along. But by the end of the next 2-3 lectures or so, you should know at least at a very high level what all these terms mean. Okay. And another useful thing about this simple n-step binomial model is that we will see that it serves as a good approximation tool to calculate the option prices, which is kind of good enough for many purposes and is used in reality and practice. Before we get on with the model, let's briefly spend some time on some aspects of the derivatives we will be concerning ourselves with. Sorry. Okay. Most of it should already be familiar to you. So we will not be spending too much time here. However, this will be just to refresh your memory on some of the concepts and terminology. Okay. So, and as the introductions go, what is the derivative? Actually, before we get on with that, you should be knowing that there are various types of derivatives like forwards, futures, options, and swaps, etc. And you should already be familiar with pricing question of forwards and futures. So we won't be spending much time on them here, but we may visit them sometime later in the course. So our main focus here would be on the options. Okay. Right. Let's get back to answering what an option is then, in fact. In very simple words, it's a contract traded between two parties, wherein the party selling the option is called the option seller or the option writer, and the party buying the option is called the option buyer or the option holder. So typically what happens is the buyer of the option has an exposure to an asset, and this asset could be a bond or an equity or a stock or share, whatever you want to call it, or it could even be a commodity like oil, gold, livestock, etc. And they could even be, of course, foreign currencies. And in the context of derivatives, we typically refer to this asset as the underlying asset of the derivative. What we mean by saying he has an exposure to an asset is that he is susceptible to the price movements of the asset. So to have an exposure, you need not already own the asset. You may have certain requirements, which means that you need not buy it right now, but you will have to buy the asset sometime in near future, if not immediately. So, for example, let's say the underlying asset is a stock in a particular company and you want to buy it, not now, but sometime in future. Let's draw a graph. So on x-axis you have the time horizon over which you may want to buy the asset, and on the y-axis you have the stock price. Let's say today the stock price is somewhere here, but you want to buy it sometime in future, say at time t here. Now you are concerned that the price of the stock could be too high at the time you want to buy it. Let's quantify what we mean by too high here. Let's say you aren't quite happy to buy if the stock price is greater than K. Now, suppose the future stock price follows this path. The stock price at time t here is given by ST, which in this particular instance happens to be greater than K, the maximum price you're willing to buy it for. And this is exactly what you didn't want at the time you want to buy the stock. But you can still buy this stock for a price of K at time t if at time 0 you have bought a particular kind of derivative called an European call option. An European call option is one which gives the option holder the right to buy the underlying asset from the option writer at a specified time t in future for a specified price K. So this contract gives the option holder the right to buy the underlying only at time t, okay? Not earlier, not later, only at a fixed time t specified in the contract. This is called the maturity time of the option. And if he wants to buy the underlying asset at the maturity time t, he can buy it for K, which is referred to as the strike price or exercise price, and all these things are written into the contract. Note that we are saying that he has a right, but he isn't obliged to buy the underlying asset. So the contract can't force the option holder to buy the underlying asset at any time. The option holder can choose to buy, that is, he has an option whether to buy the underlying asset or not. Of course, the option holder would only exercise his right depending upon whether or not it is rational for him to do so or not. That is, whether or not if it is profitable for him to do so. We will see what this all means. Now that you know what a European call option is, let's go back to our graph now. So here at time 0, suppose you have bought such a call option then with a matching maturity period T and a matching strike price K, K the maximum you want to pay for the stock. Now in our example, the stock price at maturity time T here is greater than K, like here, right? So if you exercise your right to buy the stock for K dollars from the option seller, the contract forces the option seller to sell you the underlying asset at that price. So that what you have is an asset that's worth ST dollars and you got it only for K dollars. Now, so if you sell the stock immediately in the open market, you would make a profit of ST minus K. And for this reason, you can say ST minus K is the payoff from the derivative at this time. So even if you want to keep the asset to yourself, you got it cheaper at K. Thereby, you can say you have saved ST minus K dollars. Of course, if at the time you want to buy the stock price is like here instead, that is less than K. In this case, it doesn't make sense to buy the stock from the option seller because as per the contract, he will only sell it to you at K. So you're better off buying it cheaper in the open market. So in this case, you aren't exercising your right to buy the underlying asset from the option seller. So we say the option has expired worthless at the time of its maturity. In effect, you can say the payoff at maturity of an European call option is maximum of ST minus K, 0. Okay, where T denotes the option maturity time. Because what's happening here is if ST is less than K, the option expires worthless, so the payoff is 0. And if ST is greater than K, you have made a profit or savings of ST minus K from the option. So you can just say the payoff from the option is maximum of ST minus K and 0. But that's not exactly a profit, because at time zero the derivative that you have bought would have costed you something, and it is precisely this cost, this price that we are trying to determine. Okay, determine what is the fair price for a contract which gives rights to certain payoffs in future. And as we have seen, these payoffs from the option obviously depend upon the performance of the underlying asset. So for example here, whether ST is less than K or greater than K. Okay, this is just the basic idea we touched upon in the introductory session, that any asset or financial instrument is nothing but a set of cash flows that occur sometime in future, where these cash flows are associated with certain events, and these events occur with some probabilities attached to them. Okay, so that the value of the asset is just the value of these cash flows. So we have two questions here now. If you have to find the price of the option, then okay, first is how do we determine or model the payoffs themselves, and second is what value should we attach to these cash flows. To answer the first question, note that there aren't as many cash flows to deal with here, because here we are discussing an European call option, and it can be exercised only at maturity time. So there's only one cash flow or payoff in future that occurs here. Okay, and this payoff depends on performance of the underlying share at maturity. In general, the future stock price is an unknown quantity, and so it can be treated as a random variable. Because if at the time the option matures, if the stock price is somewhere like here, we have seen that the payoff is ST minus K. But if at the time of maturity the stock price is like here, that is less than K, then the payoff is 0. And so also it would be 0 if the maturity time were here, and so on and so forth. So more generally we can draw something like this, which is just saying that the options have non-zero payoffs if at the time of maturity the stock price is in the blue part of the curve, and they have zero payoffs if the stock price is in the red part of the curve. So the option payoff is also a random variable. Okay, that's what this is saying. But the payoff value is entirely determined in our example if we know the stock price at maturity. So to answer the first question, what we need is a model, or the model for the stock price at maturity. And once we know the distribution of the stock price, we know the payoffs precisely. Okay, but if you look at the development of the stock price over a time period, it doesn't really follow anything close to such a nice path as this. Okay, but it will instead look something like this. And what kind of distribution looks like this? This doesn't look like any statistical distribution you had encountered in your earlier courses. Well, this process is an example of a stochastic process called a geometric Brownian motion. And it turns out that it's not easy to work with these kind of distributions, and you would need some sophisticated mathematics and statistics called stochastic calculus to deal with these kind of stochastic processes. And this is where the complex mathematics and statistics that I talked about in the beginning of the lecture kicks in. The complex part which we want to avoid now, because just to develop these techniques and theory will take us at least 2 or 3 more lectures, and applying these techniques further will take us another 3-4 lectures or so. And all of this really constitutes about half of the course, and by the time you're done with, you'll be mighty confused. That's why I'm giving you this introduction, so that you can remember this particular session and this particular slide in particular, and you will see how most of the things that we will do later on are all to do with contents on this one slide in one way or the other. Okay, so if you find yourself lost sometime in the future classes, you can always refer back to this one and get the context of what exactly we are trying to do in those classes. Okay, anyway, so suppose you have some distribution for the stock price then. Okay, what would be your answer to the second question here then? The right value of these cash flows. One immediate thing that would come to mind is suggesting that the value, that is the price of the option, should be expected present value of the payoff at maturity. Okay, that is mathematically it can be written as this, where CD is the cash flow at maturity, which in the case of European call option is just maximum of st minus k comma 0. In fact, we would also have to mention the probability distribution under which this expectation is calculated. So we would probably say that this expectation is with respect to some real world stock distribution process, because your payoffs depend upon the stock distribution process, right? So you're taking the expectation with respect to that process itself. Okay, so let's denote this by P. And so yeah, that should be very, very convincing and comfortable indeed. But that's again not entirely true. There's only half the truth here. The problem is with this P here. It turns out that the right price is not arrived if we take the expectation with respect to the real world stock price distribution. Okay, so the part that is half true is it is in fact expected present value of the payoff at maturity, but the expectation is not calculated with real world stock price distribution, but something else, something called risk neutral probability measure, which we will denote it by Q. And this Q is different from the real world stock price distribution denoted by P here. Though it's a bit related to the stock price distribution, the relationship between these two distributions is not at all straightforward. The reason we are starting with a simple model such as the binomial model is precisely to motivate you why this expectation is not with respect to the real world distribution, but with something called risk neutral probability distribution. So that's what the binomial model is all about, really, because it focuses our attention in answering the second question here to start with. And that's why we are not going to assume such a realistic model as geometric Brownian motion for stock prices, because our calculations to find the price of the option become very complicated. So to make these calculations easy and focus our attention on the important financial ideas and concepts first, we are going to start with a very simple model, the binomial model, which assumes that over the time period of interest, the stock price can only take two values, and that's why it's called binomial. Okay. Because it assumes only two values for a stock over a time period. This is very simplistic, but as I said, almost all the results we derived under this model will hold true in the context of more general models as well. Great. I think I spent more time here than I intended to, but I hope it would be useful. So one of the things, the other thing I wanted to talk about is in this example we just discussed, we only discussed one case, that is when you want to buy an asset in future and said that you can buy something like a call option, etc., to hedge your position and such. But if you already own an asset, you may be concerned that the asset values may be significantly low when you want to sell it in future. In this case, you can buy what is called a European put option, which gives you the right to sell the asset to the option writer at a specified time t, not whenever you want to sell it, but only at a particular time t, and for a specified price k. Okay, let's look at how the payoffs would look like for a European put option. Okay, as before, k is the strike price. However, here it's the price at which you will sell the underlying asset to the option seller. Suppose the maturity time is here, and the development of the stock price over the time period looks like this. So that at maturity here, stock price is less than k. Okay, and this is exactly what you feared. So if you bought the put option, you now have the right to sell the underlying asset to the option seller at not st but at k, so that your payoff would be k minus st. However, if the maturity of the option were here, then the price of the underlying asset st is greater than k, and if you want to sell the asset at this time, you would rather sell it in the open market than force the option seller to buy it, because he'll only buy it at a lower price of k as per the contract. So we say here the option expires worthless. This is all very similar to the call option scenario we have looked at earlier. So here the payoff can be written as the maximum of k minus st and 0. Yeah. And one final thing I want to cover before we move on to the actual model is quickly talk a little bit about American options. So just like we had European call option and European put option, we have what are called American call options and American put options, and the only difference between these two options is the time at which these options can be exercised. Okay, so suppose you bought an European option and another American option at time zero with everything else being the same. That is, the underlying is the same, strike price, maturity period, everything is the same. Now with the European option, you can only exercise it at the maturity time t. That is, the option holder can exercise his right to buy or sell only at maturity time and not any time before that. In contrast, an American option can be exercised anytime before the option matures. Okay, so this statement isn't true for American options, as it can be exercised anytime before the option matures and not just at the time when the option matures. However, it must be noted that if the option is traded on an exchange, then the option holder can sell the option in the open market to any third party before the maturity time t. And that's true for any exchange traded option, whether it's European or American option. Okay, so what I'm saying is, with the European option, though you cannot exercise your option to buy or to sell before the maturity time t, you can sell the contract itself to some third party. Okay. Well, this is it as part of the introduction to the binomial model. In the next session, we will be discussing the model itself. So hope you liked it, and please like and subscribe to the channel, or share it with your friends, whoever may be interested in, and etc. All right, guys, that's it for today. Thank you.